Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kurt Chisholm. I'll be your host, and today I'm joined with my good friend Phil Weiss. Hey, Phil.
Hey, Kirk, how are you doing on this fine Friday?
I'm doing great. I'm doing great. It's Friday before the week of Thanksgiving, and exciting. This is the time of year where things start to both speed up and slow down. Because next week, no one's doing any work. If you have to work, I'm sorry for you. I really am. I used to be that person, and that's why I run my own business, so I don't have to be that person anymore. But everybody I talk to, no one's working that week. Everyone's just kind of taking it off, or most of it off. Maybe it's so they can spend all that time shopping, spending their hard-earned money for the holidays. But whatever it is, hopefully you're going to enjoy next week. Yeah, and then there's 2 hard weeks, the first 2 weeks of December, and then I take the last 2 weeks of the year off. Christmas and New Year's fall on a Thursday, so pretty much those weeks people aren't doing much work, and so I usually take them off just because no one's around. And so you got 2 or 3 weeks at the beginning of the month, and then that's it for the year. So this is just going to accelerate. And at the same time, it's time to really slow down and relax and enjoy the holiday season with family and friends. And so I'm trying to do that more this year. Excited to do some of that in our new house. So we'll be hosting Thanksgiving. You do anything fun for Thanksgiving, Phil?
We go to New Jersey to my brother-in-law's house. And when my mother-in-law was alive, there used to be like 50 or 60 people, and the number has fallen back. And now my brother-in-law is back to inviting more people. So it'll be I would guess it'll be 30, 40 people there this year. So we'll go up for a couple days. Then we come back on Saturday because one of my sons, his birthday is at the end of the month. So we're going to come here and celebrate his birthday. He does a Friendsgiving with his friends. Also looking forward to today. My daughter comes home. Her break from college starts today, so it'll be nice to have everybody here. But
Nice.
I will work a little bit next week. I hate to admit, but a little bit. I was out last week, so that kind of means gives me a catch-up week. Like there's not a lot of meetings. It's just to catch up on stuff.
Yeah, I'm with you on that. I'm definitely working next week, but I'm going to be doing a lot less, just kind of taking a step back a little bit to try to enjoy the holiday season and all that. So that I'm looking forward to. Looking forward to spend a little time with the family. There's going to be some great Black Friday sales that we need to fill our house with furniture. So I'm thankful. I'm thankful for Black Friday right now. So yeah, it'll be fun. We gotta get a new desk for my office. I got a new chair, which is awesome. We were looking for a nice chair for the office, and it's funny because I'm just like, I'm not in a rush. I'm just like, whatever. And my wife found this outlet store, and she's like, yeah, I was just down there, and this like great chair was there, like 80% off. I'm like, that was a great bargain. So I think the lesson there is is to wait. If you want something nice, just wait. If you want to buy a great stock, wait till it's a good price. Don't overpay, because you're going to get into a situation where it's going to take you 100 years to make your money back.
Absolutely. And the recent market activity is giving us a chance to do some of that.
Yes. And so Phil and I have talked about this before, but it's going to be an interesting 6 weeks left in the year. It's going to be an interesting 6 weeks because pretty much the second half of November, with Thanksgiving being a pivot day, like the week after Thanksgiving being kind of a pivot. So it's really like December and January are typically like the best 2 months of the year. And we're heading into a period where it's been volatile it's been flat in October, and November has been volatile. It's down as of today. Well, it's actually up today, but we had a rough day after NVIDIA earnings, which we can talk about a little bit. But I think that the takeaway here is we actually have some conflicting forces in the markets right now. We have, in the short term, it's somewhat negative. In the midterm, meaning next 6 weeks to 10 weeks, it's going to be positive. And then next year is statistically the worst of the 3 years in a presidential cycle. So year 2 is always the worst. Year 1's great. Year 3's great. Year 4 is decent. Year 2 is historically the worst of the 4. Now, it doesn't mean the market's going to crash. It doesn't mean we're going to have a bad year. It just means in comparison to the other 4, statistically, it is the worst of the 4. And that's it. And that's what you should take away from it. Not that you should, sell all your stocks and go put it all in guns, gold, and MREs, although gold's probably not a bad idea. But don't get scared and jump out your first floor window. Just be mindful of the fact that is an overlay on the markets. And if you're already skittish, maybe you should lower your allocations and put more into cash. If you're over aggressive, maybe you should pull back. But you should also just be mindful of the fact that it could be completely wrong and the market could go up 50%. I don't know. I suspect not. But that's for all the other reasons that we've been talking about in the last few weeks. So there's a bunch of stuff we want to talk about, but where do you want to start, Phil? Because I've got a bunch of fun stuff today. You guys are going to love this. What do you want to start with, Phil?
I think yesterday was such an interesting day. Let's just start there, because you had on Wednesday night, you had NVIDIA release earnings, and they beat expectations. They gave good guidance, and the market opened up. It looked like it was going to be a good day, and then suddenly it reversed and went the other way. And I don't look for all these explanations. And I know as an analyst, and people would call and say, "Why is this stock doing this? Or why is the market doing that?" To say, we don't really know. We're always guessing. But I always am fascinated by the days where the market starts off strongly in one direction and then basically just turns around and goes just as far the other way.
Yeah. Yeah, it's interesting. I've been talking to a lot of people this week about NVIDIA's earnings. Everyone has been waiting for NVIDIA's earnings because I'll get into why. Like it was huge news at one point for everyone. And here's the thing: we've had an earnings season up till now, which has been mixed. Some companies are fine. A lot of companies are not. But what we've seen is as we mentioned last week on the show, the K-shaped economy. Some companies are doing fine. The people who are servicing the middle to lower part of the economy are not doing well, especially like takeout restaurants and consumer goods are struggling. And so we're seeing a lot of that. And then we're seeing certainly some companies are doing fine. Like NVIDIA said, "Oh, we're doing great." Well, here's the takeaway. We have an earnings season, which ordinarily should be okay. But the market is treating earnings season like everybody's a leper. So even if you had good earnings and your stock got crushed, what it means is that basically you didn't beat earnings enough, and that the market was expecting you to do so much better than what you beat that they penalized you for not beating it as much. So this whole game of beating earnings is all bullshit. And Phil knows this, that companies come out and they manage earnings expectations for Wall Street, and they manage it within their clients. So let's say they think they're going to earn $1 of earnings. And so they go out somewhere between last earnings season and this earnings season. They come out and say, "Well, I think, it's going to be a rough quarter, and, we're probably earn 80 cents, and, it's going to be great. It'll be better than last year." They'll manage the process somewhere in that earnings cycle. And then by the time earnings comes out, "Oh, look, we beat by 20%. We made, $1 a share," even though they were always planning on that. But they managed it lower so that you expect 80 and you got 100. Wow, look how awesome we are. We did great. And then next quarter, it's going to be like, you probably think you're going to get $1.10. And you're like, "Well, I don't know about next quarter. Next quarter is going to be tough." And then they were like, "Oh, we beat again. We did great." And they do this every single quarter. Wall Street knows the game. They dance around like a pair doing the tango. They all know what they're doing. And Wall Street's part of the game. And you people meaning every retail investor out there, are the rubes. You're the ones that don't know this game is going on. I know some of you do. And if you listen to the show, you know exactly what I'm talking about. But the Joe and Susie Publics of the world have no idea this is going on. So you get confused and you're like, "Oh my God, it's great. Look at NVIDIA. They beat earnings." No, they didn't. They beat some number, artificial number they put out there that they could hit. It's like doing the limbo, and you're trying to go under the bar. And it's like, well, the bar is like 6 feet tall, and I'm 6 feet tall. Like, well, I don't know if I can make this, and I mean, it's a crazy game, and they make it so polished, but at the end of the day, it's not really helping anybody. And so what ended up happening is Nvidia came out with good earnings. They came out with good guidance. Everyone was pleased. And then the next day, people woke up and said, huh, these numbers don't make sense to me. Yes, I know you told me this. And yes, I know you're bullish because that's your job as a CEO to be bullish. But I don't know, these numbers don't make sense to me. And so the street collectively just said, we don't believe you, and sold off. And so the whole market sold off yesterday after a good start. And everyone's like, yeah, you guys keep buying. We're going to start selling. And it completely sold off on earnings because people didn't believe it. And there's a big underlying theme going on in the markets right now about the believability and the sustainability of AI growth. That any AI related company has been growing like a weed, in stock price and, their earnings. But there's been a lot of conversation over the last month, and we've shared it on the show, about shenanigans. We call them shenanigans, Phil. I don't know what you call them, but I call them shenanigans.
Sure.
Phil knows this from being in the energy sector. You know what shenanigans are. Remember Enron? Those are
Yes.
shenanigans. So there's been a lot of memes out there about these companies, and I'm making up these numbers, by the way, so don't go look them up because I'm making them up. But here's the overall theme that OpenAI pledges $1 billion to NVIDIA, to invest in the company, and then NVIDIA uses their chips to power OpenAI, and Oracle will go fund NVIDIA with something, and NVIDIA will then go fund Oracle. So it's this round robin of there's like 5 companies, and I forget the meme, but it was like 5 companies, and they're all buying from each other. I don't know if you ever seen that Three Stooges skit where it's just like, hey, you owe me $20. Okay, great, I'll give you $20. Yeah, Larry, you owe me $20, and then he pays Mo $20, and then Larry's like, hey, I forget the other guy, Larry, Curly, and Mo. And Curly, you owe me $20. And they all like pass the $20 around. So then they all owe each other $20, but now they're all even. And they're like, wait a minute, what just happened? Right. And it kind of reminds me of that. Right. So it's like, you give me $20, I'll give you $20, I'll give you $20. So everybody's just passing the same money around, and they all market as revenue. Look at all the money we're making. This is what we call the infinite money machine. It's just like Phil and I keep giving each other $20, and wow, look, we made $1 million this year. It's just no money changed hands. Money changed hands, but we netted zero in our pocket, but we all claimed all this money. And so that's the claim that's being made for all these AI companies. Now, I'm not saying that's true because I haven't dug into the weeds, but I wouldn't be surprised. What are your thoughts, Phil? You saw Enron. You know how these games work. What do you think of all these shenanigans?
I think the last time I was on, I talked about this some too. They are shenanigans, right? We don't know what's really going on, but there's a lot of investment that's going on. And one of the things that's happening is kind of like what you're alluding to. NVIDIA goes and invests $1 billion in OpenAI, and OpenAI then uses that $1 billion to buy NVIDIA chips. So at the end of the day, NVIDIA is basically financing the purchase of its chips, and so it ends up with more sales. And NVIDIA, and OpenAI has the chips, but meanwhile, nothing's really changed except NVIDIA has a stake in OpenAI because they bought somebody, and I know that NVIDIA CEO, when he was asked about, well, we couldn't afford to do this before, that's why we're doing it now. But meanwhile, they are just buying sales. And then the last time I remember, we talked about how there was a lot of vendor financing instead of making an investment in the companies. If you go back to the internet bubble in the late 90s, you had the companies like Cisco and Lucent and Nortel. Lucent and Nortel no longer even exist. And JDS Uniphase was another, no longer exists. And they would kind of do the same thing. They would sell product to these small startup companies using vendor financing. And then those companies went belly up, and so now they had no money for these chips that they sold. At least here, NVIDIA is sort of financing it, so it's not like we have the financing part because they're disguising it as investment, but it is something to pay attention to. And I mean, and a fascinating stock to look at all this is, remember Oracle when they released earnings, and that's
Yeah.
went up like 30 or 40%.
Yeah.
It's now lower today. Well, maybe not today, but as of yesterday, I haven't looked at it today because I don't follow Oracle that closely. But it's trading below where it was when earnings came out. Because why? Because the part of this that's hard to fathom for some people and that's causing the concern is there's a lot of capital that has to be invested to build out AI the way that they're talking about. And Oracle now has a lot of debt, right? And they don't have free cash flow, which means that they have to borrow to fund their growth. It's like when Google does it, Google has a lot of free cash flow. And for those that don't know, free cash flow is basically your cash flow from operations less what you spend in capital expenditures. And that's what all these purchases are. But Oracle doesn't even have that. So where's the money going to come from? That's the issue. Like they have all this, that's what people get concerned about. I think anyway, that a lot of people are concerned about is where's the money going to come from to fund all this? And we're using NVIDIA is basically funding itself, right? And what's nice for NVIDIA when they do that is you make $1 billion investment, then somebody buys $1 billion of chips, you record the revenue, you get higher earnings, higher profits. We don't know how it's going to turn out, but I do know that when it happened in 2000, that it didn't turn out well.
Did you miss your opportunity to get PPP money during COVID? Are you waiting for our president to forgive your student loans? Are you excited about helicopter money? Me too. If you want free money, look no further. I'm giving away free money this week on our show. All I ask is 5 or 10 minutes of your time. I'm so excited to give you free money, I can hardly contain myself. Take advantage of me and my excitement to get your free money. Go to www.moneytreepodcast.com/free money. Follow the instructions today and get your free money.
Here's kind of an example of some of the things to think about. And I've seen this chart floating around a few times, so I thought I'd share it. It's comparing PE to forward returns, forward 10-year returns. And basically what the correlation is the lower the PE, the higher the forward 10-year returns are. So if your PE is like 10, you should expect like 10% or more returns a year over 10 years. If your PE is like 45, you should expect negative forward 10-year returns. Now, I would have thought it would have been more negative, frankly, but right now we're at a PE of 37, and I don't know the date of this. I'm not sure if it's actually 37, but it's somewhere around there, which means your expected 10-year forward annual returns are zero. Can you imagine that? You're going to invest for 10 years and your return is going to be zero. Now, that's how you should think of things. Now, does that mean that next year is going to be zero? No. Does it mean the next 3 years are going to be zero? No. Does it mean the next 5 years are zero? No. It means that over a 10-year cycle, you should expect approximately 0% returns, which is where we are now. Now, the thing to keep in mind is 10 years is a long time, and you're not going to be thinking about this for 10 years. But if you recognize the fact that we are way overvalued in so many areas, and at some point the market's going to correct, it's not going to be pretty. You have to remember, like 2000 to 2013 was a 13-year period where you made no returns for 13 years. That's a 10-year cycle with negative returns. And that was 2000. That was the peak of the bubble. I don't know where the peak of the bubble is going to be. Could have been last week. Could be 2 years from now. Don't know. But I know when we hit it, it's going to be a long time before you break even. So if you're not thinking about managing risk, if you're not thinking about buying overvalued companies that may never come, I mean, look at, you mentioned Oracle. Oracle's an example of this. I mean, forget their what's happened recently, but if you go back to 2000, right? If you take Oracle and go back to the monthlies back to 2000, actually Oracle's not the example. Where was it? This doesn't even go back that far. Anyway, maybe there was a company, maybe it was Cisco. I think it was
Cisco recently passed for the first time the highs that it hit around 2000. So that's probably what you're thinking of.
Yeah, I think that's what it was. So if you go back far enough, let's see the max. Here we go. So Cisco hit a peak of 80, looks like $82.
Just under 80. I think it was 78.
78? Is that what it was? My chart's not showing up properly. Here it is. No, it says here 82 in March of 2000.
Maybe it was. But it was around 80.
It was around 80. And it hit 80 recently. That's 25 years. It's 20, almost 26 years in order to just hit where it was at the peak. And I'm going to share this because I want you to see what I'm seeing here. Replace screen sharing with this. This is Cisco stock price. If you notice, they skyrocketed from 95 up to 2000. It went from $1 up to $80, and then it crashed and hit a low in 2002 of $8, and then it's slowly crept up. Well, this is what happens when you have an overinflated stock price. Clearly, you're going to hit a limit. If you expect to grow 100% a year and your stock price prices in 100% a year for the next 20 years, and realistically, you're already selling everybody routers on the planet, and you're probably not going to get that same growth. And so what ends up happening with these companies is they have to keep skyrocketing that growth expectation. But at some point, you've tapped out your audience and you can't keep growing at the same clip. So at some point, the markets recognize this and crater the stock price to realistic levels. And then the company starts growing again at a rate which is, commensurate with the markets overall. And so the fact that it's taken them 26 years to get here, I'm not surprised because at the time the stock was way overvalued, much like, if you look at, I don't know, if you look at like NVIDIA, I don't know what their PE is now. Their forward PE is 24.
It's not nearly as high as Cisco's was back then.
It's not as high because there was a point where NVIDIA's was like 200. It was just crazy, and of course it kept going up. But if you look at what's happened here, this is the earnings day, right? This is yesterday. It went up and then it's gone down and it's kind of stabilized here. But if you look at a lot of these other AI related companies, Oracle, for example, we were just talking about Oracle, and I wish I could remove this as pain in the butt. Here's Oracle, right? Came out with earnings, right? In great earnings, and it's just kind of now it's lower than where it was before. In large part because people just don't believe the story. And I'm not saying that what they're saying isn't true. I don't know. But the market collectively is not believing the story that they're telling the street. Today, the stock's down 6.5%. Well, today, the market is up. Right now, the NASDAQ is up 0.5%. I think it's actually up more, but it's up 0.5%, and that's down. Well, that's not a good sign, right? That's not a good sign at all. And so what I want you to take away from this is, generally speaking, if you're looking at investing in stocks because they're invested in AI, I want you to take a really close look at what the PE ratios actually are. Because I think what you'll find is that some of these companies are way overvalued and they will correct at some point. And if the market collectively decides and calls bullshit on the AI sector, and then things start to crater, it's going to get ugly. And I would not want to be holding AI stocks right now. Now, it could be the market changes its mind next month and all of a sudden all the bad news is good news and everything's going to the moon again. Okay. I wouldn't be holding that stuff now. I would not. Or if I was, I would have risk management measures in place to make sure I didn't lose big, because this could be the beginning of a sell-off. It could be a shakeout. To be clear, the market does this all the time. Could be a shakeout, and it goes to all-time highs. But I would be very cautious right here based on market sentiment and how the market is feeling very heavy in that sector. Now, what's going to happen is the market is going to have to come to a place where they can square the circle of what AI is actually valued at. Because right now, it sounds like everyone's just pumping up their balance sheet, pumping up their revenues with stuff that's imaginary, and it may be perfectly legal. By the way, I want to be clear because I believe they are putting in the footnotes of the statements, the quarterly statements. So I do believe they're putting footnotes in there. So it's probably completely legal. I'm not saying it's illegal, but it smells fishy. It's not something I would be comfortable with. So how would you look at this, Phil, given the fact that we're in a place where many numbers are unbelievable or not believable? What should people be thinking about here?
So I just want to, before I get to that, like Cisco is a rarity in terms of the fact that it came back. There was an old JP Morgan paper that I remember reading that talked about the percentage of stocks that at some point they hit a number that they never get to again.
Mm-hmm.
Microsoft is another exception because Microsoft actually has done really well, but it fell coming out of the internet boom. But it's because it's kind of reinvented itself along the way. It's much higher now, but a lot of stocks just do that. You have to think about these stocks with high PEs. And this is why individual stock investing is so hard, right? Because I'm telling you, some stocks hit numbers that they never get back to. We get these stocks that everybody gets excited about and they trade at these high valuations, but their growth is going to slow because the bigger you get, the harder it gets to sustain that growth rate. I remember there's an old paper I read by Joseph Lakonishok is the guy's name, but he wrote this paper about the sustainability and persistence of growth rates and the number of companies that can grow at 15% a year. That's just 15%, not some of these numbers that we're seeing now for a 10-year period is really, really small. And they used to use the PEG ratio, which was kind of the ratio of the price to earnings ratio of a stock divided by its growth rate. So, if it's 1, that's ideal. And once it gets above 2, it's expensive. And people seem to have defied that now, and they don't think it could be higher than that. But you want to kind of look at the relationship between the PE ratio of a stock and its growth rate just to get an idea, because at some point, like stocks don't sustain PE ratios of 50 and above for a long period of time, because as their growth rate slows, that PE ratio is going to come down. When we think about stocks and how they can grow the valuation, like a valuation like a PE, that can grow over time. Their earnings can grow over time, but at some point, and then you get whatever they pay you out in dividends or things like that. That's part of what you get from investing too. But as the growth rate slows, the PE ratio is going to come down, and you have to hope that it's going to grow earnings enough to grow into a PE ratio that allows you to get a reasonable return. So when you're looking for investments and you're paying attention to this stuff, look, my investing roots are value and fundamentals and things like that. When I look at companies at really high growth rates, it could be really hard. I mean, sometimes I'm wrong, right? I know, like I remember looking at Facebook, and if you go look at Facebook back in like 2013, 2014, when that stock was like half the price that it was at its IPO. And then it started to take off. But when you looked at it, it actually has defied expectations because it has grown more than we would have thought. But you just have to see how rational are the growth rates. And there's another book that I read by Michael Mauboussin, who writes a lot. He works, I think, for Morgan Stanley now, but he puts out a lot of research papers. And he has a book that he wrote with I think it was Alfred Rappaport, who was a Harvard guy, and it's called Expectations Investing. And I love the approach that they take in that book, because one of the things they try to do is, if you're trying to do a real valuation of a stock, try and look at what kind of expectations for growth the market is assuming to get it to that price. And does that growth rate seem reasonable? Because if it doesn't, then you probably want to stay away, unless you're somebody that's willing to trade a lot, which I'm not, because the more you trade, the more decisions you have to make. And I don't want to make that many decisions, because the more decisions I have to make, the more likely I am to be wrong.
Yeah. Yeah. I think that's really important context. I'm sharing something I saw in Bloomberg, or I don't know where this is in, but it's from Bloomberg. And I want to give the bullish case here. I don't want to be a Debbie Downer the whole time. So I'm going to give the bullish case. So this is comparing 6 scenarios, comparing the NASDAQ 100 since October 22 compared to a historical series of events. So it compares the Great Depression, the run up to the Great Depression, the gold boom, the Japanese asset bubble, the dot-com bubble, US housing bubble, and the China stock market bubble. And so it compares where we are now for basically the last 3 years, or 36 months. It gives it up to like 100 and looks like close to 150 months. Not all of them, some of them are less, but it kind of shows in comparison what we've done in comparison to other bubbles. Now, this, I would say in part is fake news, but I will give credit where credit's due. It is a good comparison because it just shows like the Great Depression was up, like 6x. The gold boom was up 6x. The Japanese asset bubble was up like 5.5x. Dot-com bubble was up like probably like 7x. The China stock market bubble is about 5.5x, and the housing bubble is up 2x. The housing bubble, the Nasdaq is outpacing that, but the housing bubble is different. I think that's a bad comparison. That's like comparing stocks and bonds. But what this is showing is that if you compare the Japanese stock bubble or the dot-com bubble, it's very similar. The gold bubble, a little bit, although I think that's a wrong comparison. But what I wanted to share is if you're looking at these comparisons of history, you might say, wow, we've got a lot of bullish, bubble-ish nature to go. And I would agree, we might. We don't know. I don't know the future. I'm not making that prediction. The prediction I'm making is I'm being very cautious here. I don't want to be a pig in a sector that is right now getting sunlight on it as to whether it is a legitimate sector to keep going. Now, the dot-com bubble saw the same thing. You always have the haters. And, Michael Burry came out this week and said that he's closing down his hedge fund. He wrote a big letter and said, I'm closing my hedge fund. Things don't make sense anymore. He's shorting it. He did, but right before that, he put on a short. I think it was a March 2026 short on Palantir and one on Nvidia, because he doesn't believe the numbers. Now, I don't know if that I can't think of a better mic drop than that. We're going to put on a short. We're going to buy put options, not just short. We're going to buy put options on Palantir and Nvidia. And he's going to make, I think, like, I forget the numbers. He's going to make like 20 or 50x his money if he's right. But I don't know if he's right, but he's a smart guy. He's also called 20 of the last 1 recessions. Yeah. So, I don't want to knock the guy because he's very bright and he was very astute in the housing bubble. But I think the challenge with smart people is they're frequently wrong because they're early. Jeremy Grantham, also a very notable investor, partner of GMO, a famous institutional money manager. They do great work, by the way. I love their stuff. And he came out in 1997 and said the stock bubble, it's in a bubble, the tech it's gonna crash. And so I think he sold out in tech in 97. Well, I think he lost like 40% of the assets that were with him because people were like, you're stupid, you're wrong. And he was wrong because he missed out on 97, 98, 99. That was at least 100% returns or more because those were great years. So he missed that. And yes, he missed the downside. But actually, if you see when he got out, it probably came back to the downside. So at the end of the day, he just missed a few years and he didn't get the ups or the downs. So effectively, he was wrong. Even though eventually he was right, he was wrong. Because what I think people don't recognize is it feels good to be intellectually sound in your argument. You might say, well, the dollar is going to go to zero. We're going to be bankrupt. Gold's going to the moon. You might say all those things and it might be correct, but it's not going to happen for many reasons. And so it might happen 100 years from now, or it happens 20 years from now. I don't know. It'll eventually happen. You're right. But if it doesn't happen for 20 years, you're wrong. That's the message you need to take away from this. Because I could be right. I could say the stock market's going to crash, but if it doesn't crash for 10 years, I'm wrong. Because that means I missed out on 10 years of growth, or worse, I shorted the market and the market went up, which means I lost money. That's why I don't do that stuff. Because you have to be really mindful of the fact that if you're not right for a period of time, it means you're wrong. If you think that ABC stock is going to go to the moon, but it goes down 40% first, it meant you're wrong. You might eventually be correct, but if you lose 40% of your stuff, it means you're wrong. So you need to own up to the fact that no matter what prediction you're making, it has to be attached to a timetable. It has to be, because you could eventually be right. A broken clock is right twice a day as well, but it doesn't mean it tells the right time. And so you have to think about it in that context. Timing is always important. Right now is not the time to be making big bets. Now's the time to be careful. Now, it could be next week or 2 weeks from now, that view has changed. And I'm telling you, I'm predicting it might change. But for now, you have to be really cautious. So right now, I'm not taking big bets long. If anything, I'm shorting the market a little bit, but we're protecting ourselves in case that we're, that our long positions go into a tough spot. But I do expect that we'll probably see a good end of the year. And if we don't, I'm actually more concerned. If December it ends up being a shitty month, I'm actually going to be concerned about next year. I'd be even more bearish because you're going to the best times of the year and you're not getting bullish behavior. That's a bad sign. So anyway, what do you want to look at, Phil? You're sending me some fun stuff to look at here.
Yeah. So while you were talking, I went into some software that I have, and I was looking at some AI ETFs. And you had that chart before that showed the market PE, and all of these ETFs, the average PEs for these AI ETFs is 40, 41 for the 5 largest. So just to show you how large that, and like an average, it's a weighted average. So I guess that makes me feel like it's a reasonable estimate of what the number is, but that doesn't tell you what the extremes are in there. And I don't know how the companies that might not be making any money in them yet fare in that comparison, but just shows you what the overall valuations are for these AI stocks.
Yeah, I mean, this is AI and robotics, and obviously has not had a good November. So, all right. So I want to discuss a few things here. This is my favorite thing I've read in the last 2 weeks, and I didn't get to it last week, so I'm going to get to it. All right. Here is the biggest piece of potentially fake news that I've seen in a long time. Okay. And I had to share this because it's something I completely missed. And I haven't done the research, but I saw it and like, oh my God, tell me that isn't true. I'm going to read the data and I want you all to think about this. The fake news is China has been massively lying about its population. It's not 1.4 billion people. It may be as low as 600 million. And here's the rationale behind it. In 1950, the population of China was estimated at about 530 to 540 million when the CCP took control. That requires a fertility rate of 3.3 to triple the population in 50 years, right? In 1959, the Great Famine in China resulted in 30 million deaths. Okay, so you can knock 30 million off that. So now we're down to 500 million. From 1979 to 2015, China had a one-child policy, which means you're not growing your population if you have a one-child policy. Okay, it means your population is shrinking. Mathematically, there's simply no way for the population to have grown from 540 million to 1.4 billion between 1950 and 2020. China is rapidly aging due to its one-child policy, which was too successful. They have a long history of publishing fake economic data. There's zero reason to assume the official population is accurate. I want everybody to think about this for a minute. This is an enormous aha moment that no one has said. No one. I just saw this as a tweet, and I was like, "Holy crap! Is that true?" I need to go research this. But I mention it because that sounds really true. Okay, I'm not saying it is, but it sounds really true. I studied China in college, and the Great Famine. It was a disaster. Okay. So I don't. So the question, if you see something like this, let's start to analyze this for the sake of this this podcast to help you think differently. Okay, here's how I would think about this. So I see this and immediately I go to that's true because it sounds true, and the argument they laid out is, wow, that's really true. It makes sense. Okay, so let's deconstruct it. We've got some data points. They started in 1950 at we'll call it 530 million. We'll call it that, right? Okay. The first question you should ask is that number true? I don't know. But you have to ask yourself, is that number true? Because that's an important data point in the growth rate. Is that true? Okay. Second point is, what does it take to triple to get pretty much where it is today? You need a fertility rate of 3.3. I'm assuming that's accurate. It sounds approximately right. Okay, so you need 3.3 children in the next 50 years. By the way, you should do the math and check if 3.3 is the number. I'm not sure if that's necessarily true. Actually, come to think of it, if you're tripling I'm trying to remember. There's actually math around tripling and what that means, and that's like a 3.3% growth rate. That could be true. That could be true. I have to go back and run the math, but that sounds like it could be. But you want to check that. That's an important number too. What does it take to triple? They did have a great famine, and I don't know if it was 30 million. I thought it was maybe 20, but somewhere in there. It's a lot of people, and that was claimed that there were tens of millions of people who have died. So I do believe that's true. There's a lot of research that has shown that. But it has tripled since then, and there was a one-child policy. How do you get such a large number of people with a one-child policy where inevitably that 500 million should have shrank? A one-child policy. Now, I don't know what the average growth rate is. They didn't put that in there. So my question would be, what was the growth rate of per children in the Chinese household in the last 50 years? That would be my question. What was the growth rate of children in Chinese households in China in the last 50 years? That would be, I want to see what that number is. And I haven't looked at, like I said, I haven't researched this, but just on the surface, I would want to see what's that number and where is the data coming from? So when you look at this data, it should all line up. So far what they've showed, it lines up, right? From superficial view, it lines up, makes sense. But I have some questions, right? What was the growth rate in households over the 50 years? I don't know. It's not in there. Okay, that's important. If that says it is 1.2% or something like that, like 1.2 children per household, okay, well, that lines up. If it's 3.3, I'd say, okay, well, which data is incorrect? Is the starting point incorrect? Is the household number of children incorrect? I don't know, but those are data points you should figure out. So you should always just look at things and say, isn't that interesting? Now, from what they've shown, nothing stands out to me. But if I do a little digging and look up some numbers and say, okay, that's off, isn't that interesting? So which one's incorrect? It could be the new number is incorrect, could be the old number, but you have to figure that out. So anytime, this is the reason I'm saying this is because as you're going through research of investments, this is the kind of thinking you need to have. You need to distrust everything. We have an AI boom where we're just talking about the Enron problem with the AI boom. It's fishy, right? It doesn't line up. It seems wrong. There's something off. It's that isn't that interesting is going off in the back of my head. I can't put my finger on it because, frankly, I don't care enough to go into the weeds to figure out if all these people are correct. Because all I care is what's the price say. The market doesn't believe it because the market's going down. That's all I need to know. It doesn't matter if I'm right. Let's say Michael Burry's correct because he's actually put out some articles on pointing out some of these things. He's like, here's the footnotes and here's why they're wrong. He could be 100% correct. I don't care, because if the stock market doubles, it doesn't really matter whether he's correct or not, right? You know, if the stock market's down, then he's correct. Great. I don't care the accuracy of it. What I care is, what is the market recognizing? That is what's important. Is the market recognizing the truth or not? So the China example is interesting because, frankly, if I'm a company investing in China, I'd want to know if there's 1/3 the amount of people I'm selling to than they're claiming. I might have a different negotiation strategy than if there's 3 times the number. So we know China fakes data. They've been doing it forever. And by the way, so do we. So all those of you who hate China, you should know the U.S. government fakes data too. So I'm not picking on China. We all do it. Yeah, I think it's unfortunate. And this is why I don't pay attention to government data, because it doesn't matter, because it's all fake. We talked about why, had this conversation with a guy on the show a few weeks ago. It hasn't come out yet. But the reality is if the government data is 40% accurate when they release it, it's fake. So it's bullshit. It takes 9 months to get the accurate data. So you can't wait 9 months to get it out. So it's bullshit. But 9 months later, it's accurate, but no one's paying attention to that. So the whole thing is a game. So my point is you always have to do your research. You always have to figure out like the accuracy things. But at the end of the day, what really matters is, where are things going directionally? Are things going directionally up? Are they going directionally down? If you think AI is growing, that's great. But if the price is going down, something's wrong in that equation. Then you should figure out whether you're wrong or whether the market's wrong. There's a lot of money to be made in the difference between the market reality and the spread between that and where it should be or where it will be. There's a lot of money to be made there. The difference is you could be 10 years before that spread is realized, and you could be wrong for 10 years, which means you could lose a lot of money. So that's why it's really important to focus on the present and not so much the future, because you don't know when the future is going to become the present. And that's the big problem with the markets. So that's the big brain punch we're going to give you today, and hopefully it gives you something to think about over the weekend. I'm still going to be thinking about it, and frankly, I want to do a little research into this because it threw me back. It doesn't take much to throw me back. That threw me back, and I'm just like, wait a minute, like that sounds awfully true. What's going on here? What did I miss? So anyway, we're kind of wrapping it up here, Phil. Other areas you think we should be talking about here?
Well, I guess when you were telling the story about how you could be right, but your timing could be wrong, it reminds me of the old quote from, actually attributed back to Keynes: the market can remain irrational longer than you can remain solvent, right? So it's not just being right, it's when you're right. And you talk about all these people that talk about the market crash, like Burry's an example. Like, he was brilliant, right, in 2008, 2009 with what went on in the housing market. He was certainly right. But then since then, like you said, he's forecast 10 of the last 1 recessions, or whatever the number is. Because when you have somebody that reaches out to you, I know I have, it hasn't happened for a while, but says, oh, somebody says the market's going to crash, and you look them up, and they've been saying it time and time and time and time again. And so my answer is kind of like you said: the broken clock's right twice a day. It tells you the right time. So could they be right at some point? Sure, but we don't know when it's going to be. So you have to act based upon the information that you have and make decisions based upon that. And we can't get all wrapped up into a lot of things that we don't know.
Shit. Sorry, I had to sneeze there. Yeah, there's definitely people like that who nonstop are bearish and think the world's going to end. I won't name them, but yeah.
The perma bears.
Yeah, the perma bears. You got to watch out for the perma bears. They're good to have around. You just don't follow what they say. There's plenty of people I follow that I pay for research, just so I can follow what they're saying. I don't actually take their recommendations, but I like to hear it because it helps give the other side of the equation. You want to hear bullish and bearish. So you can make up a rational decision, because at some point the bearish people end up being accurate. If you follow certain people, I won't name them, from 2008 until pretty much today, you were shorting the market all the way up, which means you lost all your money by now.
Yeah.
So it's a bad idea to listen to some of these people. But there are times where they're accurate and you want to know what they're saying, because if things do fall apart, it will fall apart in the way that they're saying. But they will be wrong for 20 years. And then at one point they'll be right. You just won't have any money left if you listen to them. That's why you have to play the middle. You have to know what both sides are saying and make logical decisions. It's like AI, like we're talking about today. It could be the best thing since sliced bread. You could make, 10x AI results from here, but it could also go down 80%. And you don't know which one's going to come first. But you have to be aware of both arguments, because this is the start of a sell-off in AI. It could stop here or it could keep going. But right now, I would not be on the side of buying the dip, because I know at some point the AI bubble is going to burst and it's going to get really ugly, just like in the internet bubble. I mean, the NASDAQ went down 80% in the internet bubble. I don't think the NASDAQ will go down 80% this time, but the AI stocks might. And so I don't want to be buying and holding long term, because I don't know where that bubble is going to pop. Now, if the markets are going up, now I might find a way to ride that a little bit, but not today. I would wait until there's a lot of bullish sentiment behind it, which right now there's a ton of bearish sentiment. I would not be jumping on buying the dip. Now there is money to be made by buying the dip. I'm just not going to be that guy. I just think it's too precarious right now. Now next week that might change if sentiment changes. I still am not getting into AI, but there's plenty of ways to play around that. You can take advantage of it, but I think the cat's out of the bag, and I think it's a question of whether the trends will keep continuing. I do want to mention a few sectors that actually are doing okay. Biotech, by the way, if you're not investing in biotech, that's one to pay attention to. Here's what's going on in biotech. That looks pretty awesome. Biotech's been in the toilet for a long time, by the way. It has been one of those areas that if you were investing in biotech, you pretty much were lighting money on fire. But the sector's starting to take off, as is healthcare, by the way.
Yeah, healthcare's doing really well. It's been the best performing sector while we've been having all this stuff going on with AI.
Yeah, and utilities have been doing fine, and so there's always. I hate to quote Jim Cramer, because he's always the butt of everybody's jokes. But there's one thing he said, which I think is very accurate. There's always a bull market somewhere, and it's true. There is a bull market. There's always a bull market somewhere, and you just have to find it. And right now, it's in biotech. It's not in AI. Technically we're still in a bull market of AI. We're in a dip, but if you want to find something that really has momentum, healthcare, biotech, utilities, industrials are kind of coming off a little bit, but there's actually also a lot of areas that are not doing well. One of them is home building. Home building has not been doing well either, and I'm trying to find a good chart here, but I can't seem to find it. So it's just something I would think about. Here's another thing I saw this week. I just wanted to share. It's not something you have to worry about today, but it's something to think about. This is comparison. So I've long held the thesis that we're repeating the 70s, and the 70s was marked with stagflation, and we're starting to see a lot of this now with stagflation. We're starting to see. We haven't quite seen it yet, but we're on the edge of maybe starting to see it. So, it started with high inflation, and then it came down, and then people thought it went away for a few years, and then it really started to pick up. So I don't know if this is accurate. This is basically overlaying two charts on top of each other, which I don't particularly love. I almost feel like this is this middle piece here, the white, is actually the first wave. I feel like it's the first wave. I don't feel like it's the second wave. So I feel like that was the first wave, and we haven't hit the second wave yet. We may not, but it feels like we're at the place where, and I share this because I'm seeing it all over the place. It charts just like this. It's basically showing that we will have inflation in the near future. I'm not sure if I buy that or not. I'm conflicted, and One of the problems with the 70s was there was mass confusion as to what was happening. I think now a lot of our levers that people use to move the markets are broken. I think a lot of them are broken, and we're not seeing true signals like we used to. You print money, it doesn't necessarily lead to inflation. It leads to asset inflation, but not overall price inflation in the economy. It's really just assets. So the Fed has been able to boost assets, but not boost anybody else, which has been creating a big divide between rich and poor. And the Fed is doing that in part because, they got to take care of their people. In part, they're trying to make sure the economy doesn't go in the toilet. So they're doing. So this is why everybody says, "Well, I hate the Fed." I'm like, what would you do in this scenario? Like, I put myself in their shoes. I'm like, I understand what they're doing. I'm not saying I agree with it. Believe me, I don't. I'm not a fan of the Fed. But the more I think about it, the more I understand. Because what are you going to do? You're going to send our economy into the toilet for the next 40 years like Japan did? I don't think that's a good idea. So I don't know what the right answer is, I guess is my point. So are we going to see inflation? Maybe. I mean, if Trump keeps beating up the Fed to drop interest rates to zero, I'm going to celebrate because I'm going to get a low mortgage. But at the same point, and I'm going to celebrate because my asset prices are going through the roof. But at the same time, I could also see rates go through the roof and our economy look like a banana republic. So honestly, I don't know what the right answer is. We're kind of painted in a corner. I think we're in for a struggle for the next X amount of years. I don't know when this stops, but I think Trump's got a lot on his plate to try to balance this out. We'll see if he can do it. But yeah, I'm 50-50 that we're going to get out of this. And 50-50 is a stretch. I'm not sure I'm that optimistic, but I would say it's good to think about. It's good to think about that we could, even though rates are going lower in the short end, they could go higher in the long end. Could be. So it's just something to think about. It's very possible. It's very possible the bond market picks up steam and says, screw you, Fed, we're taking charge. We don't trust you anymore. We're going to do our thing. That's very possible too. They haven't done it in a long time. The bond market vigilantes have been asleep and on vacation. And if they wake up and start to control things again, then we'll see what happens. But they haven't been in charge for a while. And so if they come back strong. And I would be very mindful of that happening. So one of those things, not worried about it, but I'm aware. And so when you start to see it, it's time to start paying attention. So Phil, you want to final thoughts and wrap it up here?
Sure. Two things on the interest rates. I mean, the one thing that is interesting is in this cycle that we're in right now, they've lowered rates by 150 basis points. And the 10-year rate's basically the same place now as it was when they started. It's a little over, it's just about 4%. So the bond market is not totally following what's going on with the Fed. The other thing that I want to say before we close, just something you talked about, seeing both sides, like that's confirmation bias, right? We have a tendency, all of us, to want to find people that agree with us. But when you're investing, it's really important to understand what the other side is. You don't have to always agree with it, but at least if things start to go wrong, you have an idea of what can go wrong. And then it gives you a better chance to act, as opposed to if you only find people that agree with you all the time. So that's something, to me, one of the primary behavioral biases that we have to watch out for when we're investing. That's for today. It was a good conversation. Kirk, enjoyed it. Thanks for having me on. Now, I'm Phil Weiss. My firm's Apprise Wealth Management. I know experiencing big life transitions can be stressful. My job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. We'd love to get to know you. You can visit our website at apprisewealth.com. That's APPRISE wealth.com. And go there. You can read and sign up for our weekly blog. Thanks again for having me on today, Kirk, and happy Thanksgiving.
Yeah. Thanks for coming on, Phil. Happy Thanksgiving to you too. Happy Thanksgiving to everybody. Hopefully you enjoy your Thanksgiving, spend some time with friends and family, take some time off and really enjoy.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.